Picture two neighbors, same street, same year they bought their homes, same purchase price, $320,000. Same 30-year mortgage at 6.5%. Same household income of $115,000 per year. The first neighbor made it their mission to pay off the mortgage early. Every extra dollar went toward the principal. They skipped vacations, drove used cars longer, and kept retirement contributions at just enough to capture the employer match. Their friends admired the discipline. Their financial advisor called it a smart move. At 57, they made the final payment. The house was completely theirs. No debt. They celebrated with a bottle of champagne and a feeling they could only describe as total financial freedom. The second neighbor did something that felt reckless by comparison. They made exactly the required monthly payment, nothing more. Every dollar the first neighbor sent to the bank in early payoff, this person directed to a brokerage account instead. Index funds, consistent contributions, automatic deposits regardless of what the market was doing that month. They didn't celebrate at 57. They just kept investing. At 65, both neighbors retire. The first neighbor has a paid-off house worth $590,000 and $340,000 in retirement accounts, net worth approximately $930,000. They feel proud. They feel secure. Until they run the actual numbers and discover their investments might not sustain 25 years of retirement without eventually selling the home they spent decades sacrificing to own outright. The second neighbor has the same house, still mortgaged, worth the same $590,000. They owe $195,000 on the remaining balance, but their investment portfolio holds $1.24 million. Net worth approximately $1.64 million. They retire entirely on investment income. The mortgage payment is covered by dividends without touching principal. Same house, same income, same starting point, $710,000 difference in accessible retirement wealth. This isn't a story about being reckless with debt. It's a story about a deeply embedded piece of financial conventional wisdom that sounds responsible, feels virtuous, and quietly destroys the retirement trajectory of millions of Americans who never examine whether the math actually supports it. Today, I'm going to show you exactly why paying off your house early is often the worst financial decision high earners make, what the numbers look like when you run them honestly, and the specific circumstances where accelerated payoff actually does make financial sense. Because this isn't a blanket argument against paying off your home. It's an argument against making that decision without calculating what you're actually trading away. Let me start with the foundational math most people skip entirely. When you make an extra payment on your mortgage, you earn a guaranteed return equal to your interest rate. If your mortgage rate is 6.5%, every additional dollar you pay earns you exactly 6.5%. Certain. Risk-free, that sounds compelling until you place it next to the alternative. The S&P 500 has returned an average of approximately 10% annually over the past 50 years. After adjusting for inflation, the real annualized return sits around 7% over any 0-year period in modern market history. A diversified index fund portfolio has outperformed mortgage interest rates in nearly every scenario that has ever existed. The arithmetic is direct. If your mortgage rate is 6.5% and the market historically delivers 7% to 10%, you are leaving 0.5% to 3.5% annually on every dollar you send to the bank instead of the market. On $1,500 of extra monthly mortgage payments over 20 years, that gap compounds into approximately $145,000 in foregone retirement wealth. That's not a rounding error. That's a retirement account that never got built because someone was busy paying down debt that charged less than the market was offering to pay. The people who feel most financially responsible while aggressively paying down their mortgage are often quietly dismantling the retirement they're working 40 hours a week to fund. Now let me show you the second problem. The one that almost nobody discusses until they need money and realize they don't have it. Home equity is not liquid. It is not accessible. In any practical sense, it is not wealth until you convert it. Someone who paid an extra $180,000 toward their mortgage over 15 years and now holds that money as equity cannot access it in 72 hours when their furnace dies, their car needs replacing, or a medical bill arrives. They need a home equity loan, a cash out refinance, or a sale. Each of those options takes weeks to months. Each involves application fees, appraisals, closing costs, and lender approval. Each depends entirely on current market conditions and the lender's willingness to extend credit. During a financial crisis, the exact moment you most need emergency liquidity, housing markets frequently tighten and lenders pull back. The equity you spent years building becomes inaccessible precisely when its value would be greatest. The investment account, by contrast, can be liquidated in 72 hours during normal market conditions. A 2024 Federal Reserve study found that approximately 29% of American homeowners are equity rich but liquid poor, substantial net worth on paper, unable to absorb a $15,000 emergency without borrowing. They optimize for the feeling of security. They forgot to build actual financial resilience. The third problem is the one that causes the most long-term damage, and it's almost never mentioned in the conversations people have about mortgage payoff strategy. Delaying investment doesn't just delay wealth, it permanently forfeits it. This is the compounding problem. The money you invest at 40 has 25 years to grow before traditional retirement. The money you invest at 50 has 15 years. That difference isn't linear, it's exponential. At 8% annual returns, money doubles approximately every 9 years. $100,000 invested at age 40 grows to roughly $685,000 by age 65. $100,000 invested at age 50 grows to roughly $315,000 by age 65. That same $100,000 invested 10 years later produces $370,000 less wealth at retirement. Not because of anything the investor did wrong, purely because of timing. Now, consider the aggressive mortgage payoff timeline. Most people targeting early payoff aim for completion around year 15 or 20. They make their final payment somewhere between ages 50 and 55, then pivot to aggressive investing with the money that had been going to the bank. They're starting serious wealth building at the exact stage where the compounding multiplier is running out. The early payoff plan doesn't just sacrifice investment returns during the payoff years. It condemns the investor to beginning wealth accumulation precisely when their most powerful compounding years are already gone. Someone who finishes their mortgage at 53 and then invests $2,000 a month for 12 years reaches retirement, with substantially less than someone who invested that $2,000 per month starting at 38. The math doesn't care about intentions or discipline. It only cares about time. I'm not done yet. The tax dimension pushes this calculation even further in the direction most people aren't considering. Mortgage interest is tax deductible for many households that itemize deductions. If you're in the 22% federal tax bracket, a 6.5% mortgage rate has an effective cost of roughly 5.1% after accounting for the deduction. In the 24% bracket, that same mortgage costs you effectively about 4.9%. You are not paying 6.5% for that debt. You are paying closer to 5%. Against a historically conservative investment return estimate of 7%, the spread between what that debt costs and what your money can earn is larger than the nominal rates suggest. For higher earners in the 32% or 35% bracket with larger mortgages, this deduction provides even more meaningful relief. The same people who could generate the most wealth from investing instead of prepaying are often receiving the largest tax subsidy for carrying that mortgage. Running the payoff calculation using only the nominal rate without accounting for this deduction produces a systematically incorrect result. Now I want to address the objection that deserves honest engagement, because it's legitimate. The market isn't guaranteed. Your mortgage payoff is. This is true. When you pay down $50,000 of mortgage principal, you know with certainty what interest you've eliminated. When you invest $50,000, the one-year outcome is completely uncertain. Markets have dropped 30%, 40%, and 50% in individual years. This objection carries the most weight in two specific situations. First, when you are 5 to 10 years from retirement and sequence of returns risk becomes real. A major market decline when you're 58 with limited recovery time is genuinely dangerous. Second, when your mortgage rate is genuinely high, a 7.5% or 8% adjustable rate mortgage competes meaningfully with conservative expected returns on a risk-adjusted basis. But for a 4.0 5-year-old with a 6% fixed mortgage and 25 years until retirement, the historical probability that diversified index fund investing outperforms that mortgage payoff over the full horizon is not a coin flip. It's closer to 90%. In every 20-year period in US market history, a balanced index portfolio has outperformed a 6% guaranteed return in the substantial majority of cases. Refusing to invest because markets have bad years is mathematically similar to never leaving your house because car accidents exist. The risk is real. The probability calculus still strongly favors the activity. Let me tell you exactly when paying off the mortgage early genuinely makes financial sense, because there are real scenarios where it does. The first is when you're within 5 years of retirement with sufficient invested assets and want to eliminate a fixed cost from your retirement budget. At that stage, $120,000 in mortgage balance remaining is a sensible target for payoff if you hold $1.2 million in investments. The second is when your mortgage rate exceeds 7.5%. At that level, the guaranteed return from payoff approaches or exceeds conservative investment return expectations on a risk-adjusted basis. The third is when debt genuinely disrupts your financial behavior. Some people experience enough anxiety from carrying mortgage debt that they make worse decisions across their entire financial life. They take on excessive investment risk trying to compensate, or they make panic decisions during market downturns. If being debt-free is the psychological condition under which you'll invest with discipline, the behavioral benefit has real financial value that the pure math doesn't capture. The fourth is if you've already maximized every other investment vehicle available to you. Full 401k contribution, including any employer match. Full IRA or Roth IRA contribution. HSA maxed, if eligible. If all of those are filled and surplus cash remains, directing some toward the mortgage is a reasonable use of excess funds. Here's what's critical about these 4 scenarios. They describe specific financial circumstances, not universal wisdom. The advice to pay off your house as fast as possible became embedded in personal finance culture during the late 1970s and 1980s, when mortgage rates regularly hit 12% to 18% and passive index fund investing wasn't widely accessible. The advice made mathematical sense then. Mortgage debt was genuinely expensive, and investment alternatives were limited and complicated. The financial environment changed completely. The conventional wisdom didn't. People follow the debt-free narrative, not because they've run the numbers in their specific situation, but because it feels virtuous. Financial culture has glorified debt elimination above almost every other goal for decades. Carrying a mortgage while holding investment accounts feels irresponsible, even when the arithmetic clearly and consistently favors doing exactly that. This is a psychological response dressed up as financial wisdom. Let me give you a practical framework for evaluating this decision in your own situation. Step 1. Determine your effective mortgage rate. Take your nominal rate and subtract your marginal tax rate multiplied by your rate if you itemize. A 6.5% mortgage in the 24% bracket effectively costs you approximately 4.9%. Step 2. Compare that effective rate to conservative long-term investment return expectations. Use 7% as a cautious estimate. If your effective mortgage rate falls below this threshold, the math favors investing the excess over accelerated payoff. Step 3. Assess your timeline honestly. More than 15 years until retirement, and the compounding advantage of investing is overwhelming. Within 7 years of retirement, and the calculation shifts meaningfully toward debt elimination and capital preservation. Step 4. Max out employer match before anything else. A 50% to 100% employer 401k match represents a guaranteed same-day return that no mortgage payoff strategy can approach. This step is non-negotiable. Step 5. Maintain genuine liquidity. 6 to 12 months of living expenses in accessible accounts. Before making a single extra mortgage payment, that cushion must exist. The early payoff plan that leaves you cash poor trades one vulnerability for another. Here's what's actually happening when someone commits to aggressive mortgage payoff that goes beyond what the math supports. They're solving for anxiety, not for outcomes. The mortgage feels threatening. Paying it down feels like forward motion. The investment account fluctuates and generates discomfort. The amortization schedule is linear, predictable, and provides a clear finish line. Human beings are wired to prefer guaranteed certainty over superior probability. That wiring served our ancestors well in uncertain environments. It costs us enormously in financial decision-making, where probability and expected value are the frameworks that actually produce results. The first neighbor felt deeply successful on the morning they made their final payment. They accomplished something tangible, permanent. They could hold the deed and feel it. The second neighbor felt uncertain for years. Markets declined periodically. The mortgage balance appeared on every statement. There was no single dramatic moment to celebrate. But at 65, the uncertainty had resolved into exactly what the historical data said it would. And the gap was $710,000. The first neighbor has a beautiful home they own completely. The second neighbor has options. They can help their children with down payments. They can fund their grandchildren's education without debt. They can absorb a $50,000 medical event without financial panic. They can retire at 63 instead of 67 because their investment income covers their needs. They can give meaningfully to causes they care about rather than calculating whether they can afford to. The mortgage still exists, but it's surrounded by enough invested wealth that it stopped mattering long ago. That is what the decision to invest instead of prepay actually purchases. Not just higher account balances, the freedom to determine what happens in the final third of your life without being constrained by whatever crisis, opportunity, or desire arrives next. Both neighbors made the same income, bought the same house, started with identical circumstances. One optimized for the feeling of financial security. The other optimized for actual financial security. The difference between how those two things feel in the short term and what they produce over 25 years is $710,000. Before you make another extra mortgage payment, run the calculation. Know exactly what the trade is. Know whether your specific interest rate, timeline, and existing investment position make early payoff the right decision or the comfortable one. They're not always the same thing. And for most people, in most situations, they aren't the same thing at all.